Hey, good afternoon, everybody. This is Jeffrey DeRose, the director at the CSI Tech Incubator. Thank you for joining us today for our first student workshop first student-based event of the year or the fall semester with Andrew Weber from Digital Power Optimization. Andrew, you'd like to introduce yourself?
Yeah. Hey, Jeff. Hello, everyone. Thanks for joining. I appreciate such a great turnout to hear me talk about this. I'm glad there's some interest. I am the founder and CEO of a company called Digital Power Optimization, which basically works in the cryptocurrency mining space to help get power producers into the business and make better use of their energy assets. So that's my background as it relates to crypto.
Excellent, excellent. So I think there's still a bit of a crowd still rolling in. So maybe we'll just start with some small talk, and maybe we'll give another 5 minutes for the crowd to come in, and then we'll start the conversation for real. So with that being said, thank you all. And Andrew, what's been going on with you? You were actually one of our previous cohort members. How has life at DPO been since you've left the incubator?
Yeah, it's been great. It was the winter cohort of last year, so it's been just about a year now. We've been busy. It's been an interesting year in crypto. Obviously, a lot of volatility in spot prices, but a lot of news out of places like China, a lot of news out of places like the US, and so there's been a lot going on. It's a very interesting time, and especially since Labor Day. After Labor Day, for some reason, everybody we've been talking to for a long time all decided to act at once. So we've been busy.
Yeah. So when you say that, do you mean you have a couple pilots now that have been signed on and people are mining with you?
Yeah, exactly. We started a customer pilot at a large natural gas plant back in May of this year. More recently, we've installed a pilot mining operation with one of North America's largest solar developers, which is really interesting. They do solar and storage projects, battery projects. And so they are working with us now to explore how to integrate this into their solar assets and make solar developments more profitable and make more of them.
Oh, wow. No, that's some super amazing stuff. And I got, fingers crossed for you guys. I hope you guys print out like $100 million in coins.
Me too.
Yeah, for sure. And, I think that was a great intro on your background with DPO, but can you maybe tell us a bit about your background in finance? I think that also makes you a little unique, right? Because you come from actually a pretty strong investment and finance background as well.
Yeah, sure. Among other things, I am a former U.S. Marine. I was a Marine for 4 years before going to college at the University of Iowa. I used the GI Bill after I got out. Ended up out in New York at Goldman Sachs as an investment banker. Worked as in banking for 2 years there, and then moved over to the buy side where I worked for a number of different hedge funds in New York, basically trading equities, picking stocks for investment funds. And then moved to Fortress Investment Group. My boss from Goldman, after 16 years at Goldman Sachs, left and moved over to Fortress Investment Group, which is a really large asset manager, and they have credit funds there, and asked me to join the credit funds to work structuring private credit instruments and trading public credit. So pretty, diverse financial experience, from banker to an equities guy to a credit guy, and now in crypto. But yeah. That's been the last, that was 2007 is when I started at Goldman. So a decade and a half now.
Wow, no, amazing stuff. I know you have quite the career there. Speaking of being a Marine, there's actually a really good book I've been reading. Let me actually pull it up on Audible. I should say I've been listening to. I'm curious if you maybe came across it. Give me a moment. What is this book called? Oh, Extreme Ownership by Jocko Willink. Have you heard about that book?
I haven't.
Oh man, no, it's a really good book. I guess he was like a U.S. Navy SEAL, and it's about what is it? Yeah, U.S. Navy SEALs Lead and Win, and it's a really great leadership book. Just talking about what they went through in the training and some of the real life experiences, being at war, and also translating how some of these experiences of leading a unit when you are in battle transfers over into business and your personal life. And really interesting book I've been listening to lately. I'm always trying to improve myself when it comes to leadership.
No, absolutely. I will check it. It's an extreme
Ownership.
And what was the author's name?
Jocko Willink.
I'll check it out. I have not heard of that one. But yeah, look, there's frankly a lot of Marines that have written books about, different aspects of what that experience is like. Everyone sort of has a unique experience, frankly, depending on what you do and where you serve and, when you're in, frankly. But anyway, I enjoyed it. I had a good 4 years, but, then for me, it was time to kind of get out and go. I wanted a real college experience, and it was nice going to college after a 4-year stint in the Corps. So.
I got you. Well, anywho, thank you for your service. I'm sure you've done great stuff for us as all our veterans have. So it's 2:40 now, so I think we could just jump right into the conversation. I think we have a pretty nice crowd. So for those who just came in, once again, I am Jeffrey DeRose. I'm the director at the CSI Tech Incubator. We're here to have a discussion about blockchain and cryptocurrencies, and just an introductory conversation just to help educate the students and the faculty who are in the room. Thank you all for coming. And just if you don't mind, another just brief intro on yourself, Andrew, for the newcomers.
Sure. My name is Andrew Weber. I am the founder and CEO of a company called Digital Power Optimization. We basically make use of cryptocurrency mining as a tool to help power producers maximize the value of their energy and their generation assets. And so, prior to that, as I just mentioned, a long finance background in banking and equity trading, as well as credit structuring.
Excellent. So, here's the $1 million question. What is the blockchain?
Yeah, so the blockchain is basically, it's what they call a distributed ledger, where all it is a record keeping mechanism where the record isn't kept by your bank like JP Morgan or kept by the government. It's kept by a distributed network of individuals or of private groups that basically maintain this record of everything that has happened as it pertains to this blockchain. And so the word blockchain, basically, for example, Bitcoins is broken up into blocks. And so every 10 minutes, there's a new block. That block records information, it records transactions, it records data. And then it's locked forever, mathematically. And then the next block in the chain begins, and data is recorded in this next block. And so what's interesting is the second block references the first block. And I'm already getting down a bit of a rabbit hole here, but essentially it's a security mechanism where there's a chain of related data, and you can't change anything that has already been set. And all these other computers that are operating would recognize a change in this chain of blocks. And so at its simplest format, it's a way of keeping data without any one person being in charge.
Yeah, no, that's amazing. And can you get into how does it exactly work? Like, I hear terms of like proof of work and, other things for like how this blockchain thing really works. Can you get into like how does it work?
Yeah, so Bitcoin is one type of blockchain. It is a use case for blockchain. There are many other use cases, but Bitcoin was sort of the first one that became widely accepted, and it happened to be this cryptocurrency. And what that means is it's based on this blockchain idea coupled with cryptography to allow people to store value, essentially, as a digital record. And so proof of work is what it sounds like. It means that you have to prove you're doing some sort of work in order to participate, if you will. And that, in the simplest form, is called mining, Bitcoin mining or cryptocurrency mining. And it's a bit of a misnomer. It's a bit of a term where you think about, oh, these guys are digging up coins. The point isn't really the digging up of coins. The operation of millions of computers around the globe on a decentralized basis secures this network, which has never existed before in human history. So the ability for all of these computers to be on and working toward a common goal, securing the blockchain, consumes a huge amount of energy. this is viewed as a negative among among a lot of the ESG proponents of the world. I'm one of them, but I see this in a different way. And I say, this consumes a lot of energy, but if you do it the right way, it's actually beneficial to the power grids. So in short, you have millions of computers running around the world, securing this network block by block by block. Data gets written, it's secured, the next block comes along, data gets written, and all of these computers around the world are basically verifying it without any one party telling them to do that. They're all self-incentivized. The incentive mechanism is the creation of new Bitcoin. You are rewarded with new Bitcoin for running these computers. And that's how you're incentivized to keep these computers running, because it costs a lot of money to consume this much energy. You don't do it for free. You do it because you get paid by the Bitcoin network, which distributes you new coins.
Oh, wow. No, that's really interesting. And is there any use case for like using solar energy to maybe be the energy source for crypto mining or anything like that from an ESG perspective?
There is. And so look, so this is, again, the power that these computers use has mostly come from China until lately. A lot of it was driven by coal. A lot of it was driven by hydroelectric. There's power being, there's mining done in Iceland off of geothermal. Ecuador is now doing geothermal. So there's a lot of different power sources. Hydroelectric's a big one because it's constant. Solar is a very interesting one that we're now exploring heavily with a lot of major solar developers. And we say, look, how do we deploy this for you in an intelligent way that helps you build more green energy assets, right? How do we build more green energy? How do we create more demand for green energy in a way that allows you to build more of these more profitably and accelerate the transition to renewable energy? And so that's what I find most interesting about Bitcoin. But essentially, what this is it's a store of value. Basically, you can park money there. It's the fourth apartment someone owns in Manhattan. They never use the fourth apartment in Manhattan. They're just rich. Or the $30,000 bottle of wine that's never going to get opened, or the third Picasso that you own. Some of that value is going to find its way into Bitcoin instead. Some of the value that's held in gold is going to find its way into Bitcoin instead. Some of the value that's held in equities is going to find its way into Bitcoin instead, because it's frankly a better piggy bank than most of those. And so that's the use case for Bitcoin. There is another, and thousands of other cryptocurrencies out there. There's thousands of other networks that are doing different things than Bitcoin with different use cases. Ethereum is one that many people have likely heard of. That's the other sort of second biggest name out there, Ethereum. It is a different animal than Bitcoin. It is a totally different thing, and its use cases are quite unrelated to Bitcoin, frankly. Ethereum is a platform upon which other developers can create apps and create new uses for this system, which Ethereum is the foundation of. It's very much like the internet is a technology to be used, and many companies have businesses that are related to the internet, but are not necessarily have anything to do with it, right? They're on the internet, they have websites, they're a web-based business, but their business isn't the internet. In the same way that Ethereum will be a platform that allows all sorts of different uses, which I'm happy to get into, depending on who develops specific applications for it. So Ethereum is sort of like a protocol in the same way that internet addresses are a given protocol, or how email formats are sent around. It's a universally accepted protocol, and that's sort of what Ethereum is trying to build.
That's really interesting. And I maybe want to ask, what is, or is there a difference between Ethereum's maybe blockchain structure, the way it was built and created, and Bitcoin, and like what makes Ethereum different?
So the Ethereum network is transitioning now. It was actually quite similar to Bitcoin when it was created, and they realized that that system wasn't quite going to work the way they wanted. And so they're transitioning it to a different system called proof of stake. Proof of stake is the other blockchain that is different than proof of work. So Bitcoin is proof of work, Bitcoin Cash is proof of work, Bitcoin SV is proof of work. There's hundreds, if not thousands, of coins that are proof of work that all consume a lot of energy in order to maintain their security. Proof of stake is a totally different thing. And it's based on the idea that the entities who control the coins themselves should control the protocols for that network. With Bitcoin, if one person owned 99% of the Bitcoin on Earth, they still can't control the network itself. The network will continue to operate in the exact same way because the miners and the nodes are essentially the ones that are controlling how the network operates. The owners of the coins just own the coins. It's just a store of wealth, store of value. With Ethereum, where the proof of stake model, anyone that owns coins gets a vote in the same way that anyone owns shares in a corporation gets a vote. What that means is whoever owns 51% basically dictates the rules to everyone else. They can change things, they can dictate terms, they can reverse transactions. It basically becomes their network. And so that's not good. That's not the point of the network. We already sort of have that. We have these very centralized networks that are controlled by Visa or controlled by JP Morgan or a small oligopoly of banks. The point of many cryptocurrencies is decentralization and automation of many functions where you don't need a trusted intermediary to keep track of how much money you have in your checking account, right? Like you don't need a JP Morgan because it's all out there in an encrypted fashion, locked into this data. And so, long story short, there's a different outcome with proof of stake, in my opinion, which is that you don't want any one entity to control 51% of a network because it's not a network anymore. It's basically just a dictatorship. The only way to ensure that that doesn't happen, in my opinion, and there's a lot of smart people out there that disagree with me, is to ensure that a small collection of people or groups hold 51%. And they basically agree, look, we'll always, between us, own 51% of this so that no other single party can own 51%. The most they can get is 49. And what that creates is small pockets of oligopolies where a small, 3 to 5 members, maybe 3 to 9 members, will essentially control what happens on any one of these decentralized proof of stake networks. Ethereum will have, a handful of owners eventually that sort of say, we're the ones that are making the terms of how this network is to be used. There'll be other networks that are similar, where another different collection of 3 to 9 or 11 members sort of have voting power, and they kind of dictate how this network will be used. And of course, they'll have to govern themselves and ensure that they're creating an attractive ecosystem and a fair ecosystem. But ultimately, these are not necessarily decentralized in the way that most people think of a decentralized network that doesn't have a bunch of owners. Essentially, Bitcoin network doesn't have owners. No one owns the Bitcoin network. You can just own Bitcoin.
Yeah, no, that's really interesting, and I'm curious to know, and just like if somebody, let's say, like, and this is just theory now, if somebody was able to control 90% of the mining happening in Bitcoin, would they have some kind of control over Bitcoin?
Absolutely, absolutely. But it's virtually impossible to do that at this point because it's so distributed. At some point, China was, a majority controller of the world's hash power. It's called hash power, is the world's computing power as it relates to, the securing of this network. And that's all gone. They basically kicked all the miners out. And so the mining around the world is highly distributed. And even in a sense, certain country, the United States is now the largest home to cryptocurrency mining on Earth. And it's in the hands of many, many different parties. So it's wildly distributed and decentralized to the point that no one can really control it. And furthermore, even if you did get control for a short time and sort of created a chain that was corrupted by your nefarious efforts to take over 51% and do bad things to that network, you have to maintain it. You have to keep that growing faster than everyone else on Earth is fighting back against you. So it's to be a nefarious actor in this space, it's you against the rest of the world forever. You have to continue to consume more energy than them. You have to continue to buy more computers than them forever. And no one entity can really accomplish that. So every day that goes by, Bitcoin gets more and more secure and more decentralized.
That's interesting. And, I think that's a good segue because you keep bringing up the term decentralized. Can you define for us what is decentralized finance and maybe what is the future of that?
Yeah, so everything boils down in today's world to there being an intermediary, right? There's almost always a trusted third party between you and something that you do. When you send money to your friend or you buy something in a store with your credit card, right? You're not paying that merchant directly. The Visa's paying that merchant and trusting that you're going to pay your bill. And so there's an intermediary that keeps track. How much have you spent? How much have you paid? Same thing with a bank. How much is in your checking account? If you have $5,000 in there and you write a check for $5,000, it's gone. You can't write another check for $5,000 because JP Morgan says so, and it's keeping track of that. And so that's how business is done today with these intermediaries settling trades basically constantly around the world. Title companies, escrow companies that sit in the middle of transactions that basically sort of document data and control the flow of data and are responsible for tracking it. If you automate and decentralize that, meaning no one person is in charge because the network is in charge, the network that is secured and dictated by this set of rules that everyone follows, can't be manipulated, can't be changed, it's set. And so DeFi, decentralized finance, is the idea that you can create transactions now peer-to-peer using one of these networks, where the network itself is essentially the intermediary. They're going to charge you a small fee for doing it, but it's less of a fee than your bank was charging you. And it's less of a fee than it costs you to do almost anything else today. So when you hire a title company to do some property search or lock in, the truth about this, history of chain of custody about the title of a property, you're paying them a huge fee to do that. With Bitcoin, if everything's tokenized and locked into secured mathematic identified items, then you can basically document all of this on a blockchain and eliminate huge amounts of intermediaries. Smart contracts are another one where today you hire a lawyer to write up a contract and two parties agree, and if it happens, sometimes you need enforcement, you need third parties to come in and enforce the contract, you have to sue people. With decentralized finance, you can basically both sign a given transaction and lock it in, and 2 years from now, when an event happens that you have identified as part of that contract, it automatically triggers. There is no intermediary. There's no ability to reverse it. There's no ability to undo it. It's done. It's locked in, secured. And so these use cases are many, and there's a huge number of companies that are trying to figure out how best to make use of these tools in this new digital. It's basically a direct format. All the stuff that you had to do with a normal channel today can be done with a shortcut through cryptocurrency tomorrow.
Yeah, no, that's really interesting. And just for the crowd at home, you mentioned tokenized. What does it mean for something to be tokenized?
Yeah, it just means a digital representation of its self and its physical self. So stable coins are sort of an example of, in many ways, a token of, it's a digital representation of a euro or digital representation of a dollar. Not in the same way that the dollar in your bank account is a digital representation of a dollar. That to cryptocurrency is an actual dollar because it's technically there. It counts in the money supply. And so you can match, cryptocurrency dollar with a real dollar and basically trade this across the globe much easier than you can trade this across the globe. And so JP Morgan today, a huge number of banks are settling transactions and settling trades with cryptocurrencies because it's faster and cheaper than what they were doing before.
Yeah, no, that's actually very interesting. I want to segue a little bit. Have you been following what's been going on, I think, in El Salvador with them replacing their currency with a cryptocurrency? Have you been following that?
So they haven't replaced it. They've simply made Bitcoin legal tender in addition to their current currency, right? So they basically said, look, we're trying to implement a system where merchants, should be accepting this, and we're going to give wallets to our population or make it easy for them to sign up to one and show them how to use this as a tool. Again, currency is a tool. It's a medium of exchange, right? It's a shortcut to having to barter. Like, how do you buy an airplane if you're a pig farmer? You fly to London, by trading, United, three pigs. Like, how do you do that? Well, you need a currency. Currency is just a tool, just like cryptocurrencies. And so, thinking through this as a tool is I think the appropriate way to it's the way that I think larger institutions are thinking about it. For us, it's this technology or this platform upon which to build stuff. But if you just think of it as a tool to do what you're doing today in a slightly different way, I think that's the best way of conceptualizing what's going on.
Okay, yeah, no, that's interesting. And do you have any thoughts on maybe like what the future might hold with this move by El Salvador? Should we maybe expect more countries adopting this Bitcoin route?
Yeah, I think so. I mean, look, it makes sense, right? I mean, they're not forcing anyone to use it. They've tried to implement programs to make it easier and take more control of their financial lives, essentially, and access a broader ecosystem of exchangeability, right? If you're an El Salvadorian today with Bitcoin, you can exchange directly with someone living in New York. If somebody's got a product to sell in New York, you can exchange directly with them. If you have a product in El Salvador and you want to exchange that directly with somebody in New York, you can have a medium to accept payment from them directly. Imagine being like a tech worker. You can live anywhere. You can live anywhere and take your payment from anywhere in Bitcoin or cryptocurrency without the same cross-border hassles that exists with traditional currencies today. And so the ease of transacting, relative ease of setting up these accounts is something that you're seeing more and more around the world. Ukraine is considering, or maybe actively doing it now, using some of their, government-owned power plants, nuclear plants to mine crypto. There's, I think, was it Uruguay? I think Uruguay was talking about something relating to something similar. Brazil now is talking about stuff like this. Seems to me like it's a matter of time. It's just seeing which ones do it in the most appropriate way. There's going to be the right way to do it, and there's going to be ones that mess it up. And I applaud those that are trying to innovate. I think a lot of people talk about innovation today, and these big companies say innovation and innovation and innovation. But when you get down to it, very few of them will actually innovate. They don't want their boss to fire them. They don't want to try something new. They don't want to lose money for the company. They don't want to answer to their shareholders that something didn't go the way they thought. But if you're only doing things that are going to work, then it's not really innovative. Yeah,
no, I agree. That makes a lot of sense. We have some questions coming in, so maybe we want to just ask some of those questions, and then we could get back to topic. Simranjeet asked, what happens when there aren't any more Bitcoin to mine?
Yeah, so the last Bitcoin should be mined in the year 2140, so about 119 years from now. The amount that are being produced every day gets chopped in half every 4 years, so there's this natural reduction in the new supply. There's going to be 21 million Bitcoin maximum. That's the most that will ever be mined. 18.8 million have been mined already. So there's 2 million left that will be created over the next 140 years. So it's going to get very competitive to extract these. When they're done, when it's totally mined out and there's no more there, what happens is the network should be theoretically self-sustaining through fees. And so that's the other component of a miner's income. Again, a miner being those running the computers that are securing this network. They get paid in new Bitcoin that are created every 10 minutes, and they also get paid in fee revenue. So when you send Bitcoin from here to there is a small fee. It's not as bad as what you pay your bank. It's not as bad as what you pay Western Union. With DeFi, again, it's a lot simpler depending on what you're doing with it. There's a fee. That fee accrues to the miners. And so today, that fee component of your revenue is relatively small, meaning most of your revenue is coming from the new Bitcoin that are created every 10 minutes. In the future, as wider adoption occurs, as prices go up, as this is being used more and more theoretically, the amount of fee revenue will also go up and will be enough at some point, in the year 2140 to sustain some level of network activity, which should be enough to secure the Bitcoin blockchain on an ongoing basis.
Okay, yeah, that's interesting. And now I have a question, because you said, how long has Bitcoin has been around since what, maybe 2008?
2009.
2009, and 18 million coins has been mined in 10 years, but it's going to take 100 in almost 120 years to mine 2 million coins. Why is that?
Because the amount that's being, you know, that game where you say, oh, would you rather have, you know, what is it, $1,000 or a penny doubled every day? You start doing the math of doubling and doubling and doubling and doubling, and that exponential growth creates a massive number that's far higher than what you would expect. This is the opposite of that, where the amount you're getting gets cut in half and get cut in half and get cut in half every 4 years. And so during the first 4 years of Bitcoin's life, 10.5 million coins were created. Half of them were created in the first 4 years. The next 25% were created in the next 4 years. Another 12% were created in the 4 years after that. The next 6% are being created right now. There will be another 3.25% created in the 4 years after this 4-year block. And so the amount that's being produced in a 4-year chunk is decreasing dramatically right now. We're basically getting to the point where there are very few left to be created. And so the amount that's out there is the amount that's out there, pretty much.
Well, you know, that's really interesting. So that means we will probably never get to see when all the Bitcoins are produced. I was looking forward to that day.
No. Well, that's what's interesting. So, you know, not to get too far down the mining rabbit hole, but there's a built-in difficulty reset that I think is one of the most ingenious things I've ever heard about in my life, where you can't produce them faster or slower than the algorithm prescribes. Basically what happens is this: if more miners enter the system, it makes it harder for you to solve the puzzle. And so the puzzle being solved every 10 minutes adjusts in difficulty depending on how much competition there is. That means that you can't create more than 900 Bitcoin per day. That is 900 Bitcoin created every single day by miners all over the world. It's pretty much mathematically fixed. It might accelerate for a week at a time and you get a little bit faster, a little bit slower, maybe 910, 950, 875, depending, but basically it stays pretty fixed around 900. And so it's because of that, it makes a built-in hedging mechanism where the amount you produce as a miner moves in opposition to the price. It would be like if a gold miner in Australia goes out of business, all of the South African gold miners the next day start producing more gold. They didn't build more equipment, they didn't buy more mines, they didn't employ more people. Their production just goes up magically because their peer went out of business. And so if you have more peers in business, you produce less. If you have fewer peers in business against you, you produce more. But there is a fixed supply. You can't make it faster than is prescribed, and you can't make it slower than is prescribed. It's going to be produced on this schedule no matter what.
Oh, wow, that's amazing that whoever created Bitcoin was really thinking ahead. Another question from Light Yagami. I think this is a person from Death Note. That's a show, Light Yagami. That's funny. What does investing in Bitcoin or cryptocurrency mean?
Can mean a lot of things, right? For the simple answer is, well, you can just buy the coin, right? You can buy Bitcoin, you can buy Ethereum coins, you can buy you can buy coins that represent businesses that are being built on Ethereum. It's almost like being a venture investor, where buying an early stage coin of this thing that's being produced is not that much different than buying a share in a company that's just at its early founding. It doesn't have revenue yet, doesn't have any customers yet. They got a great idea and they're building this thing, and it's going to be really interesting. That's almost like a venture investment rather than buying a security or a bond or something like that. So the short answer is, yeah, look, you can buy, let's say you have a bunch of gold. You have a bunch of gold exposure and you say, well, do I want this much gold exposure, or should I shift some of it into Bitcoin? Is that a better inflation hedge? Maybe you own too much real estate. You say, I'm overexposed to real estate, so I should, sell some of that and put some of my wealth into Bitcoin. And I think the answer for most people today, honestly, is probably not zero. The right answer for how much of this you should own, without trying to behave as a portfolio advisor, is probably not zero. I think most investment advisors would say, there's probably an appropriate, very low amount that most people should hold, in the same way that most balanced portfolios would entail owning some real estate, and owning some stocks, and owning some bonds, and owning some commodity exposure. A mixed, diversified portfolio should probably also include some cryptocurrencies.
No, that's really interesting. And you know what? Let's maybe just hop onto this topic of, what is the investment case for, cryptos?
Yeah, the fixed supply, right? For one thing with Bitcoin, the fixed supply, there's a limited amount of this. It's mathematically certain in a way that the amount of gold in the ground is not mathematically certain. We don't know. You don't know how much gold's going to extract in next year or the year after. You don't know if some meteor is going to, get captured by some spaceship from Elon Musk and go mine a bunch of gold. They're talking about that, right? Oh, we're going to go grab this asteroid and mine a bunch of gold. I don't know if that's real or not, but the supply is technically unknown. With Bitcoin, it's mathematically known. You don't know how many apartments they're going to build in New York. You don't know how many bottles of new expensive wine they might make that are going to make yours worth less. This is a fixed supply. And so it acts basically like a store of value, theoretically. Again, I don't know, a lot of smart people disagree with that. There's a lot of very smart people that say this is all garbage. I don't know, they could be right. I don't think so. But I think the investment case is that there's going to be a lot more money printed in the world. The Federal Reserve is printing money. The Bank of China is printing money. The Bank of Japan is printing money. The European Central Bank is printing money. They've been doing this for decades now. And at some point, again, there's a lot of very, very smart economists with PhDs and Nobel Prizes that say that doesn't matter and it's perfectly fine and it's okay. Maybe it is, I don't know. But I think this is a hedge against that being true. And you say, I don't know if that's true. What happens if you just keep printing dollars forever? That has been done around the world at various points in history. Usually it doesn't turn out particularly well. Maybe we have better controls and better governance today. But this is a hedge against that. Yeah. And by the way, that's Bitcoin. So, the investment case on Ethereum is a little bit different, Frank. Ethereum they're building a network that will replace a lot of day-to-day activity that happens in real life. That real life activity day-to-day has a value and a price. There's people paying fees to move money around. There's people paying fees to Visa and MasterCard. There are a lot of fee-based revenue businesses in finance. This can disrupt many of those transactions and overtake them and become the superior mechanism. And so the value that it's replacing is theoretically the value of that network, right? If you're replacing a bunch of real world value with a digital, counterpart, then it's worth that much theoretically. And so if you divide that total value by the number of coins outstanding, you have some sort of price. As more and more people build stuff on Ethereum, as this is used more and more over the next decade or two, theoretically, the more applications it will have, the more stuff in real life it will replace, thus the more value it will have. So it's kind of like a business, and you're asking, how big can Ethereum's business get over the next several decades? Are there competitors that can undercut them and do it better or cheaper? Is Ethereum going to remain relevant forever? Don't know. But those are sort of the thinking behind what it is you're actually buying here.
Okay, yeah, no, that's a great point. And for those at home, how do you invest in crypto if you actually want to? How do you buy these things?
Yeah, there's a couple of exchanges. In fact, you can, Fidelity does trade products that are basically, like owning crypto. The way you actually buy it is you go to a crypto exchange. The most common in the United States is Coinbase and Gemini. Gemini is the Winklevoss twins from Facebook fame. Both pretty reputable companies. Coinbase is now a publicly listed entity. So it has, SEC oversight and all the other oversight that you would expect from a large public entity at this point. So you basically deposit money onto one of the exchanges through, linking up your bank account or through a credit card, and you purchase these on the open market from somebody that's looking to sell them on the open market. And once you have them, they exist in your Coinbase account. You can leave them on your Coinbase account if you want. Some people argue that's not safe. Maybe it is, maybe it isn't. I think it depends on your own personal security. Generally, I think Coinbase is mostly secure if you are smart and do things the right way. But you can also remove these coins from the exchanges and actually possess them in your own home, essentially, or your own control, where you are literally the only person on earth that has access to these. The government doesn't have them. The banks don't have it. Nobody can get to this stuff because you basically create the seed code, which you write down and keep it in a very, very safe place. And that is your encryption mechanism. And basically you can take your entire bank account and replace everything that you have today with a series of 12 random words or 24 random words. And that is your new bank account. And so that is not necessarily for everyone. It's a bit intense for some people to go that far. But just today, there was an ETF announced that is a US based futures ETF, which allows you to buy an exchange traded fund the same way you would buy an exchange traded fund based on oil or on, robotics companies or on the oil sector or what have you. And it's an instrument that's recognized by the SEC and it trades on a public exchange. It's trading on the New York Stock Exchange as of today. So you can theoretically go buy this ETF and get, exposure to Bitcoin. Now it's the purists will argue that owning an ETF is not the same as owning Bitcoin. There's a saying that goes around the space, not your keys, not your coin. Meaning if you don't take the step of actually extracting this stuff and self-custodying it, then theoretically someone else has access to your Bitcoin because they have those keys. If you trust Coinbase, then they have your keys and you're trusting them that they're not going to mess it up. Frankly, it's not that different than trusting JP Morgan or trusting Fidelity, but just be aware there are different levels of control and responsibility that go along with investing in this stuff.
Okay, yeah, no, that's that was some good info. We have a lot of questions coming in, so I think we're just going to answer these questions.
Sure.
Samya asks, what do you think of hardware wallets and the necessity versus custodial accounts? Oh, you kind of just answered that question, but yeah, what do you think of hardware wallets and the necessity versus custodial accounts with Coinbase, Cash App, et cetera?
Yeah, again, I think it depends on your level of trust with the institution. Basically, when you're dealing with an institution and it's not, your self-custody, which, you mentioned a hardware wallet. So what they mean by a hardware wallet is this little piece of physical, it looks like a little calculator maybe, or a little, key fob almost. And it's a physical device that helps you secure your Bitcoin in this cryptographic way. They sell for, $100, $150, depending on which one you buy. I think they're quite good for the most part. The companies that create them have their own flaws where there was a leak of a bunch of addresses of people that had purchased these. And so the technology is fine, but someone can literally show up at your door and say, I got your address. I know you have Bitcoin. I know you have it on your hardware wallet in your house, and they bonk you on the head and take it, right? Like,
oh my God.
That's a little extreme, but that's the risk case, is that you're taking a different sort of risk by physically possessing something. And again, there's password mechanisms and ways of bifurcating your password so that it's not that easy to just bonk someone on the head and take their Bitcoin per se. But again, there are different levels of risk to all of this and different levels of security to all of this. And so the hardware wallets are, in fact, a good option. You just have to be smart, again, about what you're doing and who you're buying them from. And then in dealing with the exchanges, there's credible exchanges and reputable exchanges and ones that are not so reputable or where it's sort of buyer beware. And so, the introductory step, I would say, is to learn. Don't go buy this because you heard this talk, and don't say, oh, I got to go buy some Bitcoin. This guy sounds like he loves it. I think everyone should do plenty of their own research on what this all means and read about it before you take the step of owning anything.
Yeah, no, that's actually some good advice. Another question, let me just get the person's name. Anne asks, where do NFTs fit into the crypto space?
Yeah, so NFTs are a non-fungible token. It's basically, again, a digital encrypted representation of a physical thing, or not even a physical thing. It can just be a digital art, for example, could be turned into an NFT where instead of owning a Picasso you hang on your wall, you own this digital file that is identifiably unique. It is encoded on a blockchain. Your possession of it is encoded on a blockchain, and it's basically yours. And you own this digital asset. You say, well, what is a digital asset? That varies from a 6-second video clip of some guy doing something silly, like, lighting dollars on fire, or an artist that paints something in it and creates a digital work of art. There's also little I don't even know how to explain it, like a digital cartoon character. They're like little pixelated.
Yes, the JPEGs.
It's a little JPEG, you know,
Yeah.
and these things are selling for hundreds of thousands or millions of dollars. Again, it seems like to me, like there's probably some speculation here where people are buying things without really recognizing what they are or what they own. So I think there's a difference between the technology of an NFT and what that can be used for versus what it's being used for today, which is true of almost, you know, there's frankly a lot of things you can do with a blockchain that maybe are a good idea, maybe they aren't a good idea. But whether it is or not will come to be, you know, known, and society will figure that out, whether these things are actually worth $1 million for a little, you know, digital cartoon character or not. I have my hunch, but we'll see.
Yes, time will tell. Samia has a question again. Samia asked, she said, we recently integrated our online marketplace with OpenNote. So Amna has like an e-commerce store. Can you share your opinion on making Bitcoin the currency for the internet?
I don't think anyone's going to make Bitcoin do anything, which is the great part about this. I think Bitcoin's going to do, and people are going to use it in whatever way. It's like water finding its way into cracks. It will find its way into cracks, right? And so that's what Bitcoin is. It's finding places that it's going to be better than what is being done today. As it pertains to the internet, it makes all the sense in the world, right? Like right now you're paying Visa, or some merchant effectively is paying Visa 1.5% or more to be able to transact, right? You're basically using, you know, Apple Pay or a credit card to buy stuff online, right? How else are you buying stuff online today? You're paying somebody a fee. And even if you're not paying it, your merchant's paying it, which means effectively you're paying it. And so, yeah, I think it's a natural segue for merchants to say, wait a minute, this system works better. We don't have to pay this fee. Why aren't we accepting this? And part of the answer to that is the volatility is hard. It's been hard for these guys to manage because they're not in the business of taking risk on Bitcoin. They don't necessarily want to hold a bunch of Bitcoin and hope it goes up in value. They just want an easier way to transact. They just want a smoother, more frictionless mechanism. And so the ability for these guys to hedge out price movements, the ability for them to liquidate their sale, their revenue, their Bitcoin revenue into dollars so that they can pay their employees in dollars or pay, you know, their electric bill in dollars. All of these things are something they have to keep into account. Again, as this becomes more and more widespread, there's nothing to prevent you from getting paid in Bitcoin and going and buying pizza from a merchant in Bitcoin, and he pays the electrical bill in Bitcoin, and then the electric company repays their bonds in Bitcoin. You know, like that is probably going to happen. I just don't know over what time frame.
Yeah, no, that's a great answer. David has an entrepreneurial question. How can I make my own coin or currency with crypto?
It's a good question. So I guess the next question is, what does it do? Right, the coin that you're creating. Frankly, I'll be honest, I'm way far away from an expert in that. I am not a tech guy. I don't know the ones and zeros of how to do this stuff, but there's a lot of people doing it, right? And so a coin can be very much like a stock, where if you own, you know, again, these proof of stake algorithms, like if you own the coins and you essentially are owning a piece of that business or owning a piece of that network. And so you have to have a use case. What is your coin going to do? Is it just going to be another version of Bitcoin? Like, great, there's 3,000 of those, and most of them you've never heard of. And so what is it that your system or your network or your blockchain will do that produces value that will cause people to want to own your coin in the first place? If it's because a celebrity says so and they endorsed it, well, maybe that gets you a quick pop and a few bucks, but you have to create some sort of sustainable business or some sustainable model that people will want to use.
Yep. No, that was good. Dimaj, I hope I'm saying this person's name right. How do you mine it? I'm guessing Bitcoin. And what programs do you use in order to mine it?
So mining originally was done, people were using their GPUs in their graphics units in their home computers. There was, you know, strong graphics processors to run video games, basically. And that was kind of the strongest piece of home computing equipment that the average person would have. And it used to be perfectly adequate to mine crypto. as this has gotten more competitive, it's now becoming institutionalized. And there's huge multi-billion-dollar publicly traded crypto miners out there that are buying hundreds of millions of dollars worth of, state-of-the-art, brand new equipment, tens of thousands of units at a time. They're plugging in then with, massive multi-year power purchase agreements from huge Wall Street entities. And basically, it's becoming a business that you can't participate in realistically as an individual for much longer. And the reason is you don't have access to power that's cheap enough. These things consume a huge amount of energy. If the energy isn't cheap, you lose money. And so that's the catch, is for the average person, it's very, very difficult to mine Bitcoin. You can mine other stuff. You can mine proof of stake coins. It's a little bit different. The mechanics are a little bit different, but it's like most things, especially when it's a capital heavy industry. This is a capital heavy industry. It's like buying airplanes or buying, heavy equipment to go mine gold. You have to buy a lot of equipment to do it. And so again, Wall Street giant entities are in the best position to do this because their cost of money is lower than your cost of money. And so it is very much one of those things where scale is starting to matter a great deal. Your financing terms and financing partners are starting to matter a great deal. So, long answer getting longer. If you really want to do it as an individual, it's tough to actually do it in the way that you're suggesting. There are third-party entities that can give you sort of a pseudo exposure to mining. You can buy the public equities, right? You just go buy the stocks of a public mining company. Frankly, I think many of them are kind of expensive today, but I could be wrong. They might be a great way to get exposure to crypto mining without having to set up a bunch of computers in your basement, which is harder than it sounds. So long answer longer. If you're suggesting you want to try it, I would say don't, because it's hard. But if you just are curious about how it works, I'm happy to fill you in more. Especially, it's a lot of expensive computers hooked up to some very cheap power at an industrial scale.
Yeah, I just a question to tag on to that. What do the costs look like realistically of setting up a crypto mining operation today? Like how much money?
So the computer prices move around quite a lot because there's not much manufacturing capacity. Meaning the manufacturers of these things, when Bitcoin prices go up, miners can make more money. The manufacturers of the equipment know that, so they raise their prices. And there's not much you can do about it. So they actually clip a pretty nice spread today because there's just a shortage of people that can make the equipment that's necessary to mine. It's very, very tiny, obscure companies that most people have never heard of. They're big in the crypto space, but outside of that, nobody's ever heard of these guys. So it's going to take some institutionalization to help, with the availability, but essentially each one of those computers today is 10 grand. So if you got $10,000, you can buy one of these computers. Again, you're going to need power that's below, it's probably maybe a third of the price that you probably pay in your house. You're probably paying 15 to 20 cents at home per kilowatt hour, and you really need it below 5 cents per kilowatt hour. So again, most people don't have that. And so that's part of the challenge, is figuring out where to hook these up, where there's power that otherwise doesn't have a good use.
Oh, wow, that's interesting. Okay. Another question from Simranjeet again. How do you get into blockchain as a developer?
Good question. I have no idea. Honestly, again, I'm not a tech guy. I am the last person anyone on earth should be talking to about like hardcore tech or like blockchain development. There are a lot of developers out there that are getting into developing blockchain type apps. There's headhunters, frankly, that are looking for people that do this. So to the extent you're interested, I'm happy to try and connect you with some of these groups. But if you just start Googling like blockchain headhunters, if you have any expertise in this, they are looking for people. It's a growth sector for sure. So, the ones and zeros of coding this stuff and how it all works is frankly beyond me. But I'm happy to try and make some connections to some groups that may be more helpful.
Do you maybe at least know coding language blockchain developers are using?
No.
Yeah, I hear you. Stefan asks, or Stefan, I hope I'm saying your name properly. Do you have any book recommendations for us to read? I'm guessing maybe it looks like some entry level books into blockchain or crypto.
Here's so books. let me think about that actually. I've been spending more time reading papers like white papers and write-ups from places like Fidelity. Mass Mutual put out a write-up on their view. Grayscale put out a write-up on, valuing Ethereum. And I think, this space has been one where white papers is how everyone seems to communicate their idea. It's not a pitch deck. It's not a prospectus or whatever. It's basically like people who write these white papers and then publish them. And that's, how the original Bitcoin was released as a white paper and said, here's how it works. And so I've been reading a lot of white papers. I've been reading a lot of, and I sent Jeff some stuff that, again, he's happy. I think he will be happy to send around. It's just basically like a 10-page primer from Fidelity, which is a really nice, quick intro to like what this is, what they think it is, and what it could be. And then, a lot of these resources are available free online. So you just go hop online and start reading like these larger institutions write-ups on blockchain, on Bitcoin mining, on Bitcoin, on Ethereum, on DeFi. And so that's where the book is 2 years out of date, basically, right? No author writing a book can really keep up with what's happening today. And so the white papers and all of the news flow is where most of the cutting edge, interesting stuff is happening. I'll be perfectly honest. I spend all my day talking to energy companies. I am probably one of the least expert Bitcoin and blockchain experts that you can find. And so, there's a lot of smart people out there that know a lot more about this than I do, but I spend most of my time focused on energy, renewable energy, and how to make mining work for the energy sector.
Okay, yeah, that makes a lot of sense.
I'm not a fake expert, but I'm barely an expert. I'm a little better than most of the average people, but there's a lot going on in this space. And look, there's probably a lot of people in this call that have interest in this or an interest in computer science or mathematics. This is stuff that you should be paying attention to, and I think that there's a lot of ways to involve yourself in it that will make a lot of sense. And I think it's frankly pretty interesting stuff. I am not the right guy to talk to about that, but I'm happy to help point you in the direction of people that know more about the technology side of all of this.
Yeah, I want to say that there's a saying that a wise man always says he knows nothing. So
yeah, well, it's easier to appear smart that way. I'll say that.
Gotcha. Alan asked, what are your thoughts on Dogecoin?
Yeah, look, so it's the problem with that from what that's one where I haven't paid that much of attention to it, but it's the new supply. There's an unlimited, massive, I think there's like 114 million new Dogecoin created like every day. And so the question is, at what point does that supply dynamic, it's basically supply versus what's already out there. And so there's creating a lot more of this stuff every single day. And I think there's other coins that probably do what Doge can do better than Doge can do it. They just don't have the meme value to it. And so this one caught sort of a meme streak. I don't necessarily think that it's a better or worse coin than a bunch of the other stuff out there. It's just gotten a lot of news because of Elon and a lot of, the meme nature of it. That, Scott Minerd is the CIO of a really large investment firm, Guggenheim. And he was on Bloomberg today. And he's a believer in Bitcoin. This guy believes actually in Bitcoin and blockchain generally. But he said, I think 70% of these coins and tokens out there today are just garbage. They're just nonsense. I kind of agree with that. I think there's just too many people. Not that it's a bad thing. Like, you need a lot of competition and some will survive, some won't. The good use cases for this stuff will proliferate and people will use them. The stuff that doesn't work or is stupid will just die off. And there's going to be a lot of failures, but it takes a lot of failures to find the successes. So I don't, begrudge people out there trying to do their thing with these coins, but there's a lot of different stuff. There's a lot of copycats that all kind of do the same thing. And, as it pertains to Bitcoin and the whole proof, so, isn't something going to overtake Bitcoin? Maybe. But not only does it have to be much, much better, and there's things that actually work better than Bitcoin at being Bitcoin. The problem is that Bitcoin is now like Kleenex. Everything else is a tissue. it's got this brand name associated with it that if you're a large asset manager on Wall Street and you're 55 years old managing a multi-billion-dollar portfolio, you're not going to go seek out some diamond in the rough and try to find like this tiny obscure coin. You're going to expose yourself to Bitcoin. You're going to be like, all right, what's the one that everybody else is doing that I'm not going to look too stupid by dipping my toe? Okay, Bitcoin, fine. Go buy $100 million of Bitcoin. They're not going to go, that's how these guys think. And so that race, in my opinion, has already been run. The smartest people in this sector over the first 10 years of its existence made Bitcoin the largest market cap by a factor of 5. Why? They're the smartest people in the space. They know more about it than everybody else. They're the early adopters. Bitcoin was 5 times the size of all this other stuff before, Ethereum really started ramping up. And so the idea that Bitcoin can easily be supplanted by something else is, it's harder than you think. It's very, very hard to do that in a network like this one. Look at Facebook. Facebook wins because it's the network effect. It's the biggest social network. It just gobbles up peers and competitors and continues to expand its web of offerings. So look, I think there's worlds where multiple coins can exist. I think Bitcoin will likely be successful. I think Ethereum will likely be successful. I think several others will likely be very successful. Whether any individual coin will be or not, I don't know. Hard to say. Dogecoin's a little silly. Seems a little silly, but I don't know.
Yeah, you bring up a good point, and I'm just curious on your thoughts on this, right? So when I'm looking at cryptos, I'm looking at, what is its use case? What is its actual utility? Is this a coin that can generate revenue? Is the coin potentially profitable? And then, what's the adoption rate for the coin? Maybe what are your thoughts on how people should be assessing coins as they're doing their research?
Yeah, no, very much the same. I think all of those are exactly right. You look at, what's the new supply for one thing? What's the market cap today? How many coins exist today? How quickly are they being created? Different coins have different production schedules where some of them are a sort of a slower ramp. Some of them have a very quick new supply and then they sort of level off. So each one of these things have their own governance. The rules by which they play the game are all, up to themselves. And so if you don't like the way Ethereum works, good, go create a different Ethereum, make it better, do a different version of it that's better than the original. And so I think looking at, what these do, how they do it, why they're different or how they're different than what we're doing today and what other coins that they're competing against are doing, right? So it's not only are they competing against today's systems, but they're competing against 8 other guys that are all trying to do the same thing as you. There's very few truly unique ideas. And as soon as you have one, 10 other people hear about it in a week. And I promise you're going to have competition. And so there's a bunch of people running very hard at the same goals. And so that's, evaluating which one, good management team, have they done exits before? Have they done this before? What did they do before they started building this new platform or this new coin? But you're right, the use case is important. If it's just going up because the right rapper tweeted about it, like that's not a sustainable, you don't want to be the last buyer in that case, right? Like you want to be, if an early buyer, you better know when to get out because there has to be some reason people keep coming back.
Yeah, that makes sense. I think we have some more questions coming in. Let me just scroll down. 1 moment. Okay, I think these are just actually comments and thoughts and people saying thank you and appreciating your answers and stuff. Do you have any thoughts on XLM?
Not really, to be perfectly honest. Again, these are, you would think that somebody knows about Bitcoin and cryptos would be following a lot of these closer. There's this coin, Sol, S-O-L, that came out of nowhere this year and became like one of the biggest cryptocurrencies, just boomed. And people were talking about it nonstop for, I don't know, a couple of months. And it's still, it's still a meaningful player in the space, but the stuff comes up so quick that I frankly can't keep track of it. Again, there's too many of them for me to even to follow. And I know the general use cases, but and frankly, I don't invest in most of these. I own a handful of different things, some in greater proportions than other, but I don't have positions in like 30 different tokens or coins because I just can't, I don't know, I can't keep up with all those.
Yeah, no, that's very true. And also, your business is very focused on a specific thing.
It is.
That's fair to say. And all right, here's another question. Why do smart people like Jamie Dimon think these coins are worthless?
Yeah, it's a good one. And there are a lot of smart people that think they're worthless. It's because they don't have intrinsic value, right? The same reason a lot of people don't like gold. Like
can
Warren Buffett would rather go buy an office building and charge rent, and there's an income stream, right? You're making money with this asset, right? Go buy an airplane and rent it to American Airlines. A lot of these airlines, they don't own their airplanes. They lease them from other people. And so if you're going to own an asset, own something that produces a revenue stream. Gold doesn't produce a revenue stream. Owning a bunch of gold in a box, you don't make any money there, right? How do you have an income stream? That's what gives something intrinsic value to your average, smart investor guy. Bitcoin doesn't have it. There is no income stream here. So they look at it and go, it's all just built on trust that someone else is going to pay something for this coin tomorrow. Technically, that's right. But I would argue that the increasing trust in this isn't so much that they trust this, it's that everybody's having less and less trust in established institutions that seem to be failing many people. And they seem to be failing not just in one country or another, but around the world in many different ways, for reasons that are, depends on who you ask. And that's the problem, I think, is that, people worry about, these are insurance policies. That's the way like gold, buying a Bitcoin in many ways to me is a bit like an insurance policy. You pay a one-time premium, you own it, and you just don't sell it, because if something does go horrifically wrong with the financial system, or I don't know, presumably these might be a better store of value than others. I think the idea of buying Bitcoin and saying I'm going to buy it at 50,000 and I'm going to sell it at 150,000 so I can have more dollars to go buy a Porsche. Yeah, there's a lot of people doing that. That is just pure speculation, right? And that they don't like. These guys like Jamie Dimon, they don't like that. The intention isn't to own the asset for many people. The intention is to make more dollars so that they can go have better stuff. I look at it as, I think there will always have some value to this, even in the worst case downside. And by the way, I do own some gold, believe it or not. Like, I'm one of those guys that, yeah, I have a few gold coins. I think it's crazy not to. Like, I don't think you need to go put 100% of your net worth into gold. But if you're a millionaire, honestly, I know guys that are multimillionaires. I'm like, you own a couple of gold coins? They're like, no, that's stupid. Okay, I'm glad you have that much confidence in the world. I don't know. I've seen some pretty dicey stuff throughout history, so I don't know. I tend to be one of the guys that likes a little bit of safety, and I think this is just again exposing yourself to the possibility of a different scenario than is the expected one. And I think guys like frankly Jamie Dimon and Warren Buffett they're talking their book, right? These guys are heavily invested in the existing financial ecosystem, our existing financial and economic ecosystem, staying roughly the way that it is. And that may or may not happen. I don't know.
Yeah, no, those are actually some very good points. Just you threw a term out there, intrinsic value, just for the students at home who may not know what that is. Can you just define what intrinsic value is? So it means
value that isn't based on someone else's opinion of something, essentially, where it's not a trustless value. It's a treasury bond has intrinsic value theoretically because the US government says so, right? And that's the ultimate security mechanism on earth, is that they can just print you more dollars. They're going to print you more dollars. They'll never default on the debt. Something that has a defined use case that provides value where other things are basically speculative, right? And you say, well, I think this has value because it's going to go up. Like, again, NFTs are a good example where there's no limit to the supply, right? You can just create more and more and more of these little digital cartoons forever. So if you're paying $1 million for this one and it costs me $0 to produce another one, I'll just keep producing these, $1 million, another million, another million. Eventually that market gets saturated and they're not worth $1 million anymore. And so, right, that's one where the only reason it has value is because everybody's looking around and saying, yeah, sure, it has value, but there's nothing supporting that, if you will.
Mm-hmm. You know, on the NFT tip, I hear you about like, you know, these little JPEGs that are just random images, but I think there are spaces where NFTs might have intrinsic value, like for example, music, right? Imagine Drake putting out an album as an NFT and he sells like 10 million records.
Totally agree.
That's real cash flow.
Totally agree. Or an artist that doesn't pay a gallery or doesn't need to advertise their work in any way. They basically can sell it straight to producers that want to buy it. Again, the artistic, it's a great tool for the artistic world. Again, so it's the use of the tool. I think, again, the technology is fantastic. A lot of people are going to experience a huge amount of freedom and unique opportunities as a result of it. You just have to look at each individual use and say, is this a good use or a bad use? And does it have value or not?
Okay, yeah, that's fair. Mohammed asked, stacking in crypto space, how does it work? Are you familiar with what stacking is?
Staking in crypto. So basically staking means you basically put up your ownership of a coin for the use case it involves. So again, this gets into some complexities of like how these things work, but essentially it's basically like committing your capital, your coin capital, to a use that while you're allowing someone else to use it, you're basically collecting interest. It's almost like buying a certificate of deposit, right? Many people might not be super familiar with these, but you buy a 1-year certificate of deposit from your bank. They're going to pay you a certain interest rate, but you've basically locked it in for a year and you've agreed, I'm not going to use this money for the next year and you're going to pay me this certain amount of interest. You say, okay, fine. This is the same thing. I'm going to post my stake either as collateral or as part of this use case, and I'm going to receive a revenue stream. So that's a counter to the intrinsic value argument, right? Is that you can own this stuff and now collect a revenue stream from it. The challenge with that is if you've loaned your coins to someone else, staking technically is a little bit different than loaning, so I should be careful. Anytime someone wants to borrow your coins, anytime they are not yours, anytime you're being paid interest for something, someone else is using your stuff. When they're doing that, there is a risk that they lose it, right? And so if it's not in your possession and it's not in your legal control, then it's in someone else's possession and someone else's legal control. In the same way, I can borrow a stock from somebody, sell it in the open market today, right? That's called shorting a stock. I can borrow it from someone that owns it, say, I'll pay you rent. I'm going to pay you a little bit of fee every month to borrow this stock. But the day I borrowed it from you, I sold it to investor XYZ. Now I got a bunch of money in my pocket. And so that stock is now gone and it's been sold to someone else. Now, if this guy's trade blows up, theoretically, he's got a bunch of paper that he can pay back his trade with, and they're making him post collateral. But essentially in crypto, if your Bitcoin is gone, your Bitcoin is gone. There is no authority that can, well, theoretically, there's no authority that can just grab it back for you. If you send it to the wrong bank account, like, sorry, it's gone. If you give it to the wrong guy and he does the wrong thing with it, sorry, it's gone. Like, theoretically, they can reimburse you in dollars if they have enough. But if they don't, so it's one of those things where, again, do your own work, do your own research, and make sure that you know where your coins are going, who's holding them, and what they're being used for, and who's paying that fee. Because you're staking these coins for some sort of fee, some sort of interest payment, some sort of something is coming back to you. Who's paying you? If he's paying you money, then he's doing something to make more. And if he's doing something to make more than he's paying you, then presumably he's taking some risk. And so you just want to be careful about who's doing what with your coins and where they are and where they're going.
Yeah, no, great answer. And now I learned about that staking. Didn't know about that. We have 10 minutes left. Does anyone have any last minute questions before we wrap up? Speak now or forever hold your peace. You guys did ask actually some really great questions. It seems like our students are actually pretty informed about crypto. I'm very impressed by the questions.
I'm impressed, not surprised. There's a lot of smart people out there, and this is one of those things that people pay attention to. It's the knowledge base is getting more and more distributed, and there's a lot more people that look, once you learn about this and really get into it, you say, wow, this is actually a pretty interesting tool. You become one of those people that go tell your friends and try and explain it. So yeah, look, good questions from everyone. I appreciate everyone, being on here and listening to me ramble about this stuff for a while. Happy to, if you do have any follow-up, happy to talk anytime. Jeff knows how to get a hold of me. And, he does have some materials that I sent to him that are like, yeah, I'm sure he'll forward them if you ask. It's, again, Fidelity put out a research piece back in mid 2020. I think it's Mass Mutual put out a research piece. Grayscale put out a research piece on Ethereum. So again, these are relatively, short and consumable, and I think will give you a pretty good foundation upon which you can start, thinking about where to learn more.
Okay. Yeah, excellent. Thank you so much for that. And I guess we can wrap up here. Once again, Andrew from Digital Power Optimization, thank you for just taking the time out of your busy day. I know you're working on a lot of deals, but appreciate you coming back to just give some knowledge to our students. I think we want to do another, maybe more of a workshop style. There definitely were some students giving feedback that this was a little over their head. So maybe we could come back and do a real introductory workshop presentation for them, just to give them that foundation in blockchain and cryptos.
For sure. And I will say on our website, digitalpoweroptimization.com, it's a little bit of a mouthful, but we have a mining primer posted, which basically steps you through a lot of this that shows the network. It shows a lot of the mining kind of back end. And again, the mining stuff it's a pretty industrial activity, but it's the core foundation of how this all works. The fancy tech stuff is not necessarily my realm, but I do know some developers and some groups that if you're interested in talking more about, the really interesting, cool tech side of all of this, there's certainly a deep rabbit hole to go down. So have a look at the mining primer if you're interested. And again, I think happy to do a workshop of some sort, Jeff, if helpful.
Yes, thank you so much. All right, so thank you everyone also for showing up. You guys asked great questions. We will be sending out a follow-up email with all the resources that were discussed in the call. Is it okay if we share your contact info, Andrew?
Sure.
We'll share Andrew's contact info, his website. And thank you guys, and looking forward to doing more events with the students.
Thanks, everyone.
Have a great day.
Appreciate it.
Yeah.